Jim Brogan.
It's time for Dollars and Cents this week, which is how we look at some good financial tips to help you have the best years of your life during retirement. And this week for Dollars and Cents, I really want to dive into the times that we're investing in now and how that's different than other times when all the markets are healthy. And this is a little bit of a misnomer, is that the market is always up. You know, we've all heard that. Oh, the best way to invest for the long term is in stocks because the market is always up over time. Well, not so fast. It depends on how much time you're talking about. I mean, certainly if you're 20 or 30 years old and you're investing for 40 or 50 years, certainly you can be focused on, you know, investing stocks for the long run. Although I will say, you know, if you lived in Japan and invested in the Japanese stock market in 1991, if you'd put $100,000 in 1991, you'd have roughly half of your money now, and it's 19 years later, and actually it'd be even less than half your money. But just looking at the United States specifically, I've got a graph here that looks at the return of the stock market since 1900. Actually goes back to 1896. And basically from 1896 to 2010, so we're talking 114 years. Are stocks always up? Well, not necessarily. We have had 4 sustained bull markets, and we have had 4 sustained bear markets. And here's what, and we're in the midst of that 4th sustained bear market. We've had 3 prior to now. The first was leading up to the Roaring Twenties. The second was during the Great Depression. The third was from the mid-60s to the early 80s. And now we're in the 4th. And one thing I want to point out about this is the shortest historic bear market run that we've had since 1896. The shortest was over 16 years. And a 16-year period where the market was down for the 16-year period. You know, if you look at the last 10 years, the market is minus. If you'd put $100,000 in the stock market 10 years ago, you would now have, if you just duplicated the returns of the Dow Jones or the S&P 500, you would now have less than 100,000. We have a negative return on all 4 of those historic bear markets. And again, the shortest was over 16 years. The stock market, the best was a 25-year period where the market was up about 1.5% in 25 years. Now, that encompassed the 30s, which, of course, was the Great Depression. But even looking at the other 2 and the 3 that we're in now, all those others, we had a minus return over 16 to 20 years. So is the market always up? Well, not necessarily. And if you're in retirement or close to retirement, you can't necessarily depend. I mean, you can't wait 30 or 40 years. So my point is this. In this type of a market run, and we don't know how long this current bear market that we're in that started in 2000, we don't know how long it'll last. It could last 1 more year. It could last 10 more years. Who knows? My feeling is I've preached for many, many months here and actually talked a lot about in our New Year's show, the first Sunday in January of 2010, is that I believe we're going to continue to see more of this boom and bust market that we've seen for the last 10 years, where the market is up, it's down, it's up and down. We've had booms, we've had busts, but over the 10 years it's been about flat or a little bit down. I personally expect more of that, but we don't know. We don't really know. My big point, though, is in that type of a bear market run, you simply cannot invest in the same typical mix you would in a historic bull market run that lasts for 15 to 20 years. You just can't do it. I mean, you just won't see the same results. And I have a chart here that shows me that the typical traditional balance that I see that most financial advisors and stockbrokers and most investors use is a balanced mix of stocks, both U.S. stocks and foreign stocks, and U.S. bonds. And a 60-40 mix is pretty normal that I see. That's the way a lot of mutual funds are balanced, and that's the way a lot of portfolios are balanced, is 60% stocks all over the world and 40% U.S. bonds. That's the mix. Well, that mix, the last 10 years, has not done that well. And I have a chart. It has done better than the S&P 500 or the Dow Jones. but it has been extremely highly correlated. In other words, it's moved pretty much in tandem, parallel with the market. It's just its downs and its ups haven't been quite as much because of the balance of the bonds. But it's the world stock, and that mix, by the way, is 60% the world stock index, the Morgan Stanley World Stock Index, and 40% U.S. bonds. And one thing that's interesting is over the last 10 years, that mix has made very, very little money. It's made a little bit, but less than 20%. If I look at the worst case scenario over the last 10 years or going all the way back to January 1st of 2000, the worst case scenario, the market from high to low in that balance of 60% world stocks, 40%, which includes the United States, and 40% U.S. bonds, the worst period was a minus 41% drop. And remember, if you lose 40%, to get back to break even, you've got to make 67%. Now, the market lost 55%, but that blend, because of the bonds, lost 41%. So to get back to break even, you've got to make almost 70%. And it stayed down from going down in that trigger from the high point to the low point. It lasted 16 months. Okay. So that traditional balance of world stocks and U.S. bonds lost 41% and stayed down for 16 months. Now, if you use a more diversified approach, and I've talked about that on this show, I think in these historic bear markets, you've got to have a more diversified approach where you have more than just stocks and U.S. bonds. For example, international bonds is kind of a non-traditional holding that I think people need. Precious metals is a non-traditional investment. Real estate and energy are a little bit more non-traditional. Inflation-protected securities here in the U.S. There's a whole list of things that are a little bit more non-traditional, but see, here's why those things are important. The idea really behind diversification is you have a lot of things in the portfolio that don't move together. So if one zigs, maybe the other zags. That way, if one of them's way down like stocks, that doesn't mean they're all way down. Okay, so don't misunderstand me. I'm not saying don't hold any stock market exposure because, just as soon as I say we're in this historic bear market, which we are, well, I say historic. We've had 3 of these in the last 100 years. This is the 4th. As soon as I say that, we'll see a new bull market trend start. That's a true bull market trend. I don't think that's what we're in right now. So, you do need a mix. The big thing is you don't want to be guessing on what the market may or may not do. But if you have a lot of things that don't move together, then you can expect less downside risk. And so instead of losing that 40% that you would have lost in the worst run in the last 10 years with that mix of 60% stocks, 40% U.S. bonds, maybe you could have minimized that and been at maybe 10 or 15 or 20 or worst case scenario 25%, but maybe 15 to 20 would be ideal. Then you would have recovered that by now, even more so. Because, recovering from a 20% loss, you got to make 25%. That's a little more doable. You lose 40%, you got to make 67% to get back to where you were. And that's that cruel math of investing. So my tip this week with dollars and cents, and we've just spent the bulk of the show today talking about the economic challenges we face and why I think this bear market is going to last a while, where we're going to see booms and we're going to see busts for the next 6 to 8 to 10 years. You've simply got to handle things differently than you do in those bull market trends that last for 16 or 18 years. The market is not always up if you're looking at a 15 or 20 year cycle.